Ladies and gentlemen, good day and welcome to the Hindustan Foods Limited Q1 FY23 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Kothari, Managing Director, Hindustan Foods Limited, for his opening remarks. Thank you and over to you, sir.
Thank you, Kathy. Good afternoon and welcome everyone for our Q1 FY23 earnings conference call. Thank you for taking the time to attend this, especially after a holiday yesterday. I'm joined on the call by Ganesh Agekar, who is the Executive Director, Mayank Samdani, the Group CFO, Vimal Solanki, the Head, Emerging Businesses and Corporate Communications, and SGA, our Investor Relations Advisors. I hope everyone has had a chance to go through our updated investor presentation, which was uploaded on the stock exchange and our company websites. Overall, I am pleased with the performance of the company in the last quarter. We have achieved our highest ever turnover and profitability numbers on a consolidated basis. And given that the ice cream facility and the RB shawl facility that we've talked about before will start contributing significantly to these numbers in the coming quarters, we are confident of meeting our guidance both in terms of revenues and profitability. This quarter, the team that has commercialized our ice cream facility deserves a special mention. While in terms of the turnover, it didn't contribute much in this quarter, it was a tough and a successful startup. Right from managing the complex procurement to manufacturing and commercializing all the formats of ice cream, sticks, cones, cups and party packs. I think this facility and the team is a testament to our ability to service our customers' requirements in new geographies and in new product categories. The highlight of the coming quarter, which is Q2, will be the integration of the RB shawl facility, which we finally signed the agreement on 1st of July. Given its EOU status and the compliance requirements of pharmaceutical products, this integration is probably going to be quite challenging for us as a team. However, we are very excited to see what we can do in this field and are also aggressively looking at more opportunities in this sector. As far as the medium term is concerned, while the slowdown of FMCG demand and the inflationary pressures have definitely affected our customers, it has also led them to rethink about their manufacturing strategies and explore ways of becoming more nimble and lean. One way, of course, is to outsource more. And in that regard, I'm confident that given our track record, we will continue to be the chosen manufacturing partner for the FMCG companies. I will now hand over the call to Ganesh Agekar, our Executive Director, to brief you on the operational highlights.
Good afternoon, everyone. I would like to highlight the operational performance of Q1 FY23. All the existing units of the company were stable and performed as per expectations. The new color cosmetic acquisitions was completely integrated and the factory achieved its highest ever turnover in this quarter. We have started manufacturing a host of new products at the facility and we are confident that this unit will be able to service the growing requirement of the customers. The wholly owned subsidiary HFL Consumer Products has successfully commercialized the ice cream plant in Uttar Pradesh. Post the monsoon winter lean season, the plant is poised to deliver 15,000 litres per annum of ice cream, going into the peak season by the end of FY23. This includes the expansion project at the site, which should be online by Q4 FY23. Reckitt Benckiser Shawl India Limited acquisition has been successfully completed. The company is working on the integration plan of the same. The recently merged beverages plant in Mysore did record turnover in this quarter. The beverages plant unit has an order book higher than its capacity and we are working on expanding the capacity. Based on the current plans, we expect the unit to be profitable in this financial year after 2 years of painful pandemic. The merger of the Malt Beverages plant at Coimbatore has also been completed, and the board has sanctioned an additional investment of 10 crores at the Coimbatore site. The work on this project has started, and we expect to complete this by September. The project work at the Hyderabad Bar and Soap project that we have been talking about for the last few quarters, I am relieved to say that it has finally started and is expected to be completed by Q4 FY23. Despite the vagaries of commodity inflation and integration of new factories and new product categories, the company has managed to service the customer demand and achieve nearly 600 crores of turnover. I would now like to hand over the call to Mayank Samdani, our Group CFO, to take you through the financial results of the quarter ended 30th June 2022. Thank you.
Good afternoon, everybody. We have commenced the quarter on a good note, and we are on track to meet our estimates. As the newly acquired companies and the new factories start ramping up, the action has started shifting to the consolidated numbers of the company instead of the standalone numbers. We have hit the highest ever turnover and the profitability figures on the consolidated basis in this quarter. In the next couple of quarters, as these companies and projects start ramping up, we expect the consolidated figures to converge with the standalone figures. Our total revenue for the quarter increased by 30% on a year-to-year basis to rupees 598 crores in Q1 FY23 as compared to 461 crores in Q1 FY22. EBITDA for the quarter has seen a growth of 43% year-on-year and stood at 38.6 crores as against 27 crores in Q1 FY22. Profits after tax grew by 48% year-on-year to rupees 9 crores, which is the highest ever reported by the company. In this regard, I have to mention that we believe that the company will be able to reduce its tax bill from next year as compared to the 35% tax bracket that we are currently in. EPS numbers have been recasted after the split, and our EPS for the quarter was rupees 1.32 versus 0.89 last year, a growth of nearly 50%. As on June 30, 2022, our net worth stand at 319 crores. Gross block an increase from 550 to 649 crores on account of commercialization of the new factories and lines, though they are yet to contribute fully to the revenue and profitability figures as they are yet to ramp up to their full. Despite that, our debt to equity ratio remains steady at a comfortable position of 1.16 on the consolidated basis, and our interest coverage ratio remains at a strong 5.8 times. We reiterate our near-term and long-term targets for revenue and profitability as we to focus on accelerating growth through exploring organic and inorganic opportunity. With this, we have remained focused on strengthening our balance sheet and cash flow through effective capital management, which would facilitate us for the first. With this, I would like to open the floor for questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask a question. The first question is from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Yeah. So, Samir, there is a enabling resolution that we have asked for 300 crores more equity raising. So, is it just an enabling resolution, or we may even raise equity in the next 2 or 3 years?
So, hi Faisal, good afternoon. It is an enabling resolution, but the very definition of enabling means that at some point of time we might raise it. But for the time being, we have no definitive plans. The enabling resolution is for, as you are aware, and we'll have to take it up in the AGM. Since just in terms of the timelines and the legal processes, we've been advised that it's always better to keep an enabling resolution so that it gives us flexibility at any point of time to be able to look at raising funds, etc.
So nothing on the anvil as such, or nothing which will be done in the next. It all depends on the opportunities that come up.
Absolutely, Faisal. I mean, I think you answered the question. Depending on how the opportunities shape up, we'll probably be able to give some definitive answers on this.
And can you give some idea on how the this beauty and wellness and the whole pharma contracting business is shaping up for us, and whether the development in charge has been able to make some good inroads for further business?
So the beauty segment and the health and wellness segment are two different ones. The beauty one is the AeroCare acquisition, which is the color cosmetics one. That has actually integrated very well. We hit our highest turnover last quarter as far as that company is concerned, and we expect that will continue going ahead as well. We mentioned that we should be able to do around 100 crores of turnover out of that facility, and I think we are well on track to do that. As far as the health and wellness is concerned, that's the RB Shawl facility. We are getting some very good feedback from our customers. Sanjay, who is heading that business, recently visited London and met the customers there as well. And I can just say that right now I think we are very cautiously optimistic that we should be able to integrate that facility well into our system and also look at any other opportunities that can come our way in that sector.
Okay, thank you very much.
Thank you, Faisal.
Thank you. Reminder to all the participants, to ask a question, you may please press star and 1. The next question is from the line of Ajay Thakur from Anand Rathi. Please go ahead.
For taking my question. I have two questions. First one was on the margin. So if we were to look at the margin for the quarter, it was more like 6.4% versus more like 5.9% in the base quarter. Even on sequential basis, we have seen a bit of improvement on the margin front. So can you just elaborate on what has been driving this margin improvement? Is there a seasonality factor, or what is the reason behind this improvement?
Ajay, I'm going to ask Mayank to answer this question, and then I'll give some operational details once Mayank has given you the financial details.
So there are two things here, Ajay. One is that you have correctly said that these are the product mix has also changed in this quarter. Ice cream, as we have started manufacturing ice cream, which have better margins as regards other products. And secondly, some of our products is on the conversion cost model also, which is nearly done. Just like in ATC, we are doing Tata on the conversion cost basis, where there is no RMPM cost, only conversion billing is there. So you will see the margin betterment in there also.
Okay.
And Ajay, from an operational perspective, yes, there will be some amount of seasonality coming in. Now that Mysuru facility has finally, we have an order book which is hopefully making the facility profitable. This quarter was the highest turnover for Mysuru facility. That's ended up reducing our burn rate in Mysuru quite a bit. The next couple of next at least 4 or 5 months will be lean quarters as far as beverage season is concerned, as well as ice cream is concerned, and then again it will ramp up. So you will see going ahead some amount of margin variability from quarter to quarter as far as our numbers is concerned.
Okay. The second question was more on the ice cream unit. So you have indicated that there would be approximately a 200 CR kind of investment into the unit. And if I were to look at the asset turns, and assuming that there could be around 2 to 3 times asset turns, so we would be making more like 400 to 600 CR kind of a turnover. But just trying to understand, if we were to do manufacturing for one of the large kind of a company, so 600 or maybe even 500 to 600 CR kind of a the revenue potential that we would be looking at in 3 years' time for the ice cream unit, that itself for a large vendor would constitute like 50-60% of their business, if I'm not mistaken. Would that be the right assumption?
No, Ajay, what you're looking at when you look at revenues for us is manufacturing cost. When you look at it from a customer's perspective, it's their realizable value, right? And generally, in case of FMCG products, the difference is a factor of 2. Which means the manufacturing cost is practically half of the net sales realization of the brand owners. In case of certain products like aerocare, etc., in case of color cosmetics, etc., it could be higher. You could get to a manufacturing to NSR of 3. So I don't think you can draw a parallel from our turnover to the customer's turnover directly.
The question that I was trying to come across from the fact that we don't have many players in the country who would be having 1,000. As in, there would be few obviously who would be having a turnover of 1,000 plus kind of in ice cream segment. But if I were to look it from the perspective of the customers, for them to outsource just to you, or maybe you being one of the other two kind of outsourcer in the ice cream segment is what I was trying to wonder. Would you be getting almost like a half of their share in terms of the revenue for large?
No, okay. So maybe I misunderstood. So the first thing that I need to tell you is that no, our turnover will not constitute half of our principal's turnover. And I think instead of looking at turnover, maybe you should look at it in terms of volume. So if you're looking at around 15,000 tons of volume of ice cream being made at the facility, a large brand, even a regional brand for that matter, and we are in touch with some regional brands as well. Regional brands sell around 15 to 20,000 tons within a couple of states, right? So if you look at it from that perspective, I think that will give you a better idea that the national brands are much larger. The regional brands have that kind of scale already. The second thing that you have to note is this particular facility is probably going to be amongst the largest ice cream facilities in the country. However, it's not necessary that all future ice cream facilities, if we decide to do any, will be of the same size. They could be smaller, they could be manufacturing only cones or only sticks or only cups. So there's a lot of variables there in terms of what we could do in the ice cream sector. Did I answer your question?
Yeah, you did it right. You had addressed it. So
okay.
That's quite helpful. Thanks. Maybe I will look at it more from the volume perspective. Thank you. Yeah.
Thank you. Reminder to the participants to ask a question. You may please press star and 1. The next question is from the line of Dipti Kothari from Kothari Securities. Please go ahead.
Yes. Good afternoon. Thank you for the opportunity, sir. So my first question was that you mentioned that the next leg of growth would be via inorganic or organic acquisitions. So can you throw some more light on the same?
Dipti, if you track our company, we've been very aggressive in terms of M&A. We've always been looking for opportunities. We've talked to our customers who are looking at divestment. We've also looked at consolidation of the contract manufacturing industry by acquiring some of our competitors, etc. We will continue to do that. I am unable to give you any specifics or give you any more color around it. All I can say is that we continue to look for assets which will help consolidate the contract manufacturing industry, and we also continue to look at assets where a customer is either not interested in running the factory or incapable of running a factory or has lower capacity utilization in a factory, and they are looking at diverse assets in our favor. So we continue to look at that very aggressively. I'm sorry, but I can't give you any more color around that.
Okay, sir. And sir, what are the new segments that we are looking at venturing into?
You mean apart from home care, personal care, pesticides, infant foods, leather shoes, beverages? Apart from that, we're looking currently at health and wellness as a sector, Dipti, and within the FMCG space, we're also looking at pet foods. Within the space, we are quite agnostic in terms of what product categories that we can manufacture.
Okay, sir. And sir, which of your product category has the largest outsourced manufacturing opportunity? Can we please share that out of this total 1 lakh crore opportunity? What is the potential size for OTC healthcare market?
It's difficult to slice that in terms of product categories. And frankly, if you look at that 1 lakh crore figure that we mentioned, that's probably only the FMCG industry. And you know that it's a back of the envelope calculation, right? What we've done there is we've taken the total FMCG size of the market and then split it up into manufacturing cost. The health and actually is a sector which is probably as large as the FMCG sector. And in that case, we are going to concentrate only on the products and products which have an adjacency towards, or rather are next to the FMCG segment. Very difficult for me to look at, or very difficult for me to tell you product category has the largest potential. All of them have equally. I mean, just a few days ago, we were in discussion with some government officials who are thinking of doing a PLI for the or some kind of an incentive for the leather sector and the shoe industry. And I think that could become a very, very large business for us as well. So it's very difficult for us to do that.
Okay. Thank you, sir. That answers my question.
Thank you. The next question is from the line of Akhil Parekh from Centrum Broking. Please go ahead.
The opportunity. Samir, my first question is on the inflationary trend, right? So how does the volumes of our end consumer impact our business? Because in last Concall you had mentioned that the inflation shouldn't ideally impact us negatively. So that's first question. If the inflation sustains and if the end consumer volumes continue to be on a lower end, will that impact our sales? And second, in an inflationary trend, does our margin profile improve given that we operate on a fixed EBITDA margin in the dedicated manufacturing units?
Okay, so two questions. One is what happens in an inflationary environment to FMCG market in general. So two things. There are certain staples which, in spite of the inflation, the demand is quite defensive. What ends up happening is that the customer then downtrades. So if they were using a more expensive, let's say, shampoo, they will using a cheaper shampoo, or they'll start buying a sachet instead of a bottle. Given the fact that we've diversified across brands, across product categories, we believe that any customer downtrading will not end up affecting us. The second effect of inflation is reduced consumption. And that's some of the things that most of our customers have been talking about in their investor calls, where they are seeing that customers are reducing their per capita consumption. That is something that definitely affects us. But it affects us more in terms of the future growth rather than the current facilities. As far as the current facilities are concerned, especially in case of the dedicated manufacturing, as you are aware, we have long-term contracts which have a minimum guarantee. So we have very clear visibility of what the turnover will be for those facilities. However, any kind of reduction in the FMCG consumption definitely affects expansion plans of our principals, and in turn it affects growth plans for us. Hopefully, India being such a huge population and the demographics, we don't see that this temporary blip of reduction in the volume will last more than a quarter or so. And fundamentally, I think the consumption story of the country will continue. And as a result, we really don't think that's a major issue. Now, coming to the margin profile, I'm going to ask Mayank to talk about the effect of inflation on our margin.
Hi, Akhil.
Hi.
So, Akhil, as per our contract and we are passing through all the RMPM costs to our customers. So any increase or decrease in the RMPM cost will directly pass on to the customer. So no, the question answer of it is that in the inflationary trends, our margin profile does not increase because of the increase in the margin, because of the increase in the prices of the commodities, because it is directly passed through to the customer on a monthly basis.
But on an absolute basis, does our EBITDA increases in inflationary trend on a like-to-like basis? For example, if I'm manufacturing a soap of 100 rupees yesterday and today I am selling the same soap for 110 rupees, on absolute EBITDA level, will our EBITDA improve in
So the cost will also increase by 10 rupees in that case, Akhil. So our EBITDA remains in the figure, in the rupees, it will remain same. Percentage-wise, it will go here and there in the inflationary trend.
Okay. Fair enough. And second question,
So the cost will also change by that much effect.
Got it. So what do you imply?
Samir again.
Yeah.
So mathematically, when you look at a fixed EBITDA that we get, right, which is guaranteed in case of our dedicated factories,
correct.
If the sales volume goes up, our margin profile defined as a percentage of sales will actually go down, right? Because our sales will increase, correspondingly our COGS will increase, but our EBITDA in absolute terms will remain the same. And as a result, the percentage will go down. I think one of the main things that we've tried to highlight earlier in terms of our dedicated manufacturing model is that our bottom line, which starts from EBITDA and then downwards to ROE or the PBT and PAT, are pretty much guaranteed irrespective of what happens to the top line.
Okay. So when you say guaranteed, it means EBITDA per piece is guaranteed. That is what you're trying to imply, right?
No. EBITDA per factory is guaranteed.
Okay.
Right.
Probably,
You got your answer, Akhil, or should I?
No, I got it, but probably I'll just go deeper into it, and if I have questions, maybe I'll connect you back on this question.
Sure.
And second question on the receivables front, right? So one of our largest clients, if I look at it, their receivables are broadly at 10 to 15 days, but our payable days are at 60 to 90 days. So there is a dichotomy between these two numbers. So if you can please help me understand this.
Yeah, I think this was a question which I think someone had asked in our previous call as well. So let me just address it in a very simple way, that when you look at the larger customers or when you look at our customers, all of them have their own factories and they also have a contract manufacturing facility. If you look at our case, that would be very similar in terms of what our customers have in terms of payables, because the raw material and the packing material suppliers who supply to us also supply to the customer. As far as the outsourcing receivables are concerned, the payment terms are far more favorable, and that's for historic reasons in terms of how the outsourcing and the contract manufacturing industry in FMCG has evolved. I'm happy to take that question offline because it entails some amount of history lessons about how excise regime was and how tax had to be paid on FMCG products, etc. But to make a long story short, our payables will be the same profile as that of our customers. However, our receivables will be far better than the payables of our customers.
Okay. Got it.
I'm sorry if I've confused you on this, Akhil.
No, if I need help, I'll connect you.
Please, because I have addressed this question earlier and I'm happy to do that offline with you if you want.
Sure. Thanks a lot, Samir and team, and congratulations and best wishes for coming forward.
Thank you so much.
Thank you. Reminder to all the participants, to ask a question, you may please press star and 1. The next question is from the line of Nikhil from PIA. Please go ahead.
Yeah. Hi, Samir and team. Congrats on a good set of numbers again. So my first question is the difference between the standalone and consolidated top line is close to 35 crores. So is majority of that contributed by the new aero products facility, or does ice cream also contribute significantly to it?
So Nikhil, out of we have a difference of 34 crores between console and standalone. Out of this, 24 is being contributed by the Aero Care unit and 10 crores is by ice cream unit.
Okay. So the ice cream unit has barely contributed. Hopefully, we'll see that start contributing in the second half.
Ice cream unit started in May in this quarter, and it was in ramping up stage. And ice cream is a difficult category also.
Okay. So are you through the testing and validation phase, and can we expect smoother quarters going ahead?
Yes, absolutely. But having said that, you're also coming into a monsoon lean season in the next couple of next 3 to 4 months. As a result, we will not see any significant turnover coming in from the ice cream factory for the next 3 or 4 months. But post that, I think we should be able to ramp it up completely to 15,000 tons, as we mentioned in.
Okay. So does this also work like the seasonality in beverages, where Q4 and Q1 is, where the revenue is front-loaded and we see lower revenues in Q2 and Q3?
Absolutely.
Okay.
Summer products, Nikhil, so consumption during the summers goes up substantially. In case of the ice cream factory, we are also located north, where the effect of winters and summers is far more significant than, let's say, the south facility in Mysuru, where the difference between the summer temperatures and the winter temperatures is not that much.
Noted. So, in terms of concentration of seasonality, it will be higher in terms of summers for the ice cream facility. Right?
Absolutely.
Okay. Now, so given the slowdown in FMCG volumes for the last whole year, how does the deal pipeline look? What's the status on being awarded new large projects?
So the deal pipeline has definitely slowed down, but for us, the deal pipeline is nearly 1.5 to 2 years, right? Because for a new factory, that's the kind of gestation period. One casualty of the slowdown has been the Hyderabad bar facility, which I think we've been talking in our investor calls and our presentations for nearly 3 quarters now. We've finally started work on it in this quarter, and we expect to start production by Q4. So obviously, what happens is and that was the point that I was trying to make, that when customers start reducing their consumption, the overall future growth and the deal pipeline becomes a little bit slower. We've been fortunate so far that we have enough, or we had enough stuff in the deal pipeline, which will take us to the kind of numbers that we've guided, but there's definitely some amount of slowdown. This is also, incidentally, an interesting time for consolidation, because when there's stress in the market overall, we also get more opportunities to consolidate the industry in terms of buying out competition or doing some kind of a merger or a takeover there.
I hope you are raising funds for the same. Of course, as we being interested in the company, we will want you to acquire something at lower valuations. All the best for that. Last 2 questions from me is the bar and soap project. You just mentioned that. I just had a question that in the PPT it mentioned somewhere that the phase 1 of the expansion is being implemented now. So does this come in phases, the 150 crores, or the phase 1 is worth 150 crores?
The 150 crores will be phased out, and that's one of the casualties of the slowdown. While the initial contract was to set up all the lines put together, because of the slowdown, we've had to phase it up. Our first phase investment will be close to 60 crores, and then hopefully the market will start looking up, and then we'll come back to you in terms of the second phase.
Okay, and the second phase will also take another 6 months whenever you plan to do it, or does that happen in a shorter time frame?
It will happen in a shorter time, because what we are going ahead and doing is we are building the civil infrastructure for the entire capacity.
Noted. And one last question is, whenever you mention the quantum of capex, now I know that your working capital is negative or close to zero in the business. So all the capex pertains only to the fixed assets, including the building and civil and the plant and machinery. Just asking for confirmation.
Absolutely, yes.
Okay. No problem. Thank you. That answers all my questions. All the best for the coming quarters.
Thank you so much.
Thank you. Reminder to all the participants, to ask a question, you may please press star and 1. The next question is from the line of Priyanka Singh from Aditya Securities. Please go ahead.
Hi team, good afternoon. I had two questions. First one is, can you throw some color on the current industry scenario and how is the demand like?
Priyanka, I think you've heard from people far smarter than me and far more experienced than me. If you listen to conference calls by Britannia, HUL, Dabur, etc., I think I would end up just repeating the same, that there's definitely some amount of stress in the immediate short term as far as demand is concerned. However, I think everybody remains bullish about the medium term performance of the industry.
Okay. And is there any demand supply gap? Like, has there been any significant impact of FMCG slowdown on our business?
Considering that we just posted a record turnover in the last quarter and we are continuing to maintain our guidance, we believe that we should not be affected by this slowdown. Like I was mentioning earlier, this kind of slowdown will definitely affect our deal pipeline. However, we are also looking, our deal pipeline consists of greenfield projects as well as acquisitions. And as a result, we continue to remain confident even about our deal pipeline in spite of the slowdown.
Got it. Thank you.
Thank you, Priyanka.
Thank you. The next question is from the line of Nishita Shah from Raval Securities. Please go ahead.
Good afternoon, sir. Thank you for taking my question. So I just have two questions. Firstly, I wanted to ask, are we seeing any ramp up in demand in the next couple of quarters?
Nishita, I certainly hope so. The fact that the bar project has been finally green-lighted means that our customers are beginning to now look at some green shoots in terms of demand coming back. And from our perspective, for the existing factories, it's very difficult for us to make an estimate of how demand will be in the next quarter, especially in case of the dedicated factories where we have guaranteed volumes, etc. But overall, I think you should definitely see in FMCG demand coming back by the Diwali quarter.
Okay, sir. And so secondly, just wanted to understand, is there any destocking that we are seeing at our customers' end?
Nishita, I'm not sure, right? I mean, I don't think I would be privy to be able to answer a question about what kind of destocking is happening at the customer's end. I can say that again, I'm repeating that since we've had a record turnover, it definitely means that we've been able to ship out the maximum amount of product that we could. Whether this product is going and sitting in the customer's warehouse or whether it's actually going to the end customer, I really don't have an answer for you. I think, like I was telling the earlier caller as well, that people who listen to conference calls of Unilever, Dabur, etc., will testify that all of them have hinted that there is some amount of slowdown. All of them have also hinted that they think that things should start turning around as soon as by next quarter or so.
Okay, sir. This was helpful.
Thank you.
Thank you, Nishita.
The next question is from the line of Sachin Shah from SS Securities. Please go ahead. Sachin Shah, you may please go ahead with your question. Your line is unmuted. As there's no response from the current participant, we move to the next question from the line of Vijay Chauhan from Drive to Horizon. Please go ahead.
Yeah, thank you for the opportunity. So most of my questions have been answered already. I just had one query, like we mentioned that the bar, soap and bar plant will be in the phased manner going ahead. So are we expecting some kind of like revenue ramp up from Q2 or it will be like coming from the Q4 itself?
Vijay, we expect commercial production to start in Q4. In terms of phase 1, in terms of ramp up, I would say Q1 of next financial year is when the phase 1 will ramp up completely. Between now and Q1 of next financial year, I'm hoping that we get a sign off on the phase 2 as well. And if that happens, we'll come back to you and give you appropriate disclosures about what we are looking at in terms of revenue ramp up from phase 2.
Right. And so if the ramp up is going to happen in, let's say, the Q1 of the completely for the phase 1 in the next financial year, so and now we have lean quarters for the ice cream plant and also the beverage side. So, like what kind of like revenue target we are looking for by at least for the FY23 if we are looking at, because the ice cream and beverage plant will be also at a lean like growth side.
So I can't give you like a definitive target. What we've guided is that we'll be able to get to a 4,000 crore turnover by FY25. I think we are very confident about that guidance, and we believe that we'll be able to reach there for sure. If you look at this Q1's performance, we are at around 600 crores, which gives you an effective annual run rate of around 2,400 crores. Given the other things that are in the play, your guess is as good as ours about where we will land up between 2,400 and a higher number, whatever that is.
Right. Yeah. Thank you for the clarification. Yeah.
Thank you, Vijay.
Thank you. The next question is from the line of Yash Zaveri, retail shareholder. Please go ahead.
Yeah, hi. About your guidance of 4,000 crores, you think you'll get there without diluting any more equity? And the other question is, in FY21, your top one customer was about 85% of your sales. What was it in FY22? Thanks.
So I'm not sure, Yash, where have you got the number of 85% of sales for the top one customer?
About 1171 crores out of 1400. It's from your annual report.
Okay, I'm going to have to check on this because I'm not sure about that. The top three customers for us.
Okay.
Hello?
Yeah, please go on.
Yeah. So the top three customers for us definitely contribute around 85% of our turnover. The largest being Unilever and Reckitt Benckiser. We generally avoid giving specific numbers as far as our customer breakup is concerned. Like you are mentioning, if it's in the annual report, it's definitely a screw up from our side, and I need to check on this. But in terms of the customer-wise breakup, we generally avoid giving that. In terms of customer concentration, I'm happy to give you a broad number, which is that I think nearly 80 to 85% of the business will come from the top three customers.
And when you hit 4,000 crores, it will continue this way?
Yes.
Or? Okay.
Yeah. So that's a difficult question for me, Yash, about the revenue guidance. And here's what we have mentioned, right? To achieve turnover of 4,000 crores, given what we have already announced, we will not require any dilution of equity capital at all. However, in case we have any opportunities in terms of acquisitions or new projects other than the ones which have been announced, we will probably then look at raising funds, in which case our revenue guidance will also probably change.
Okay, just one more question. For your business, currently you're pretty healthy on your debt metrics. So what do you think the optimum amount of debt is for a business and balance sheet like yours?
Yes, we are very comfortable position as far as the company level debt is concerned. We are very comfortable. We can go ahead because our debt is indirectly guaranteed by our customer also. So we are okay to take more, but we are consciously trying to have this type of debt equity ratio in mind.
So about 5 times interest cover and about 1 to 1.5 times debt to equity is what
right, so we are at 1.16 as console basis. We can move at up to 1.4, 1.5. We are okay till that time.
Okay. Yeah, that's all from me. Thanks.
Thank you, Yash.
The next question is from the line of Shanti Patel from Shanti Patel Investment Advisors. Please go ahead.
Good afternoon. I joined your call little later. As far as I understand, our turnover by 2025 will double of what we have got today, and EBITDA will remain same. Am I right?
Mr. Patel, I'm not sure I understand the question. EBITDA will remain the same, meaning you're saying the broad percentage?
That is right.
Hello?
Yes.
Yeah. So we believe, as far as the dedicated manufacturing is concerned, we believe that it will definitely remain around the same level.
And the turnover, correct? Turnover will be twice of the turnover we have got today.
Mr. Patel, excuse me, this is the operator. We are unable to hear you clearly. Can you please check your line?
Sure. 1 minute.
We request you to rejoin the group while we take the next question, sir. We have the next question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Notable hires that we have made in the last 4 to 5 months in M&A or in the new verticals or even in the old verticals, because with the kind of growth that we are always going to target, we will have new skin and shed the old skin.
I'm sorry, Faisal, I'm not sure I got the question.
Any notable new hires that we have made in the last 5 to 6 months, new at the top execution?
Yeah, of course, Faisal. Across the board, we continue to hire new people at various levels. And like we had mentioned, from a corporate perspective at a senior level, Sanjay has been appointed as a director at RB Shawl, and he has gone ahead and recruited his team. We've also got the entire team of RB Shawl who has joined us, including the senior people of Reckitt Benckiser Shawl. They are now being integrated into the organization, and they will be given additional responsibilities across us. So in terms of people, that's a continuous it's a continuous process for us in terms of recruitment.
Thinking of changing the hierarchy or changing the corporate structure ever with the kind of growth, because what may have worked so far may not work with much larger volumes, or you don't feel the need to do that?
In terms of the org structure or in terms of the corporate structure?
Hierarchy, the reporting structures and all, do you feel that any kind of changes would be needed with much larger revenues? Because, our stock is at 100 times multiple always, and the market is always betting that you are, going to double the revenue every 2.5, 3 years. So that's like a, very, it's a horse that you're riding, which will need a lot of changes, and agility at your end as a top leader.
So Faisal, first of all, I should be thankful that you didn't say that we are riding a tiger. It gives me bad memories of the letter that the Satyam guy wrote. But on a serious note, you are absolutely right. We are looking at changes in terms of our org structure as well. The addition of as the head of the health and wellness division is a new experiment for us, where a gentleman is being given an entire sector and is being given P&L responsibility for it. We are also actively looking at recruiting a chief operating officer, and I'll come back to you once that position is filled. There will be changes in terms of how we work. Ganesh will be happy to talk about his team and what he's doing in terms of implementing ERP across the factories. We are actually upgrading our ERP system and doing a lot of work on processes, etc. But Faisal, this is something that we have to do as a basic price of admission, right?
This is exactly what I wanted to hear. People being given P&L responsibility, having a COO, running the operations on a more micro level, and you being more free. So, I mean, my kudos to you, and I mean, you have done exactly what, I thought you should be doing. And not that my thoughts really matter, but I mean, this is what I actually wanted to hear. Thank you so much.
Thank you, Faisal.
Thank you. The next question is from the line of Shanti Patel from Shanti Patel Investment Advisors. Please.
Madam, are you getting my voice?
Yes, we can hear you now. Yes.
Yeah. My question was, by 2025, what will double?
I'm sorry,
Mr. Patel, we are unable to hear you. Ladies and gentlemen, there seems to be a disconnection from the management line. We request you to please stay connected while we reconnect the management. See, you reconnected to the call, and Mr. Patel has moved out of the queue. We are unable to hear him. So I hand over the call to the management for closing comments, please.
Thank you so much. We are elated as HFL yet again has delivered the best ever quarterly results, and we were able to keep our promise of unprecedented performance on our journey of rupees 4,000 crore revenue. With seasonal support from our customers, a solid all-round working team, committed management, and with our decentralized manufacturing strategy, we have been able to embrace every opportunity that came our way, making the most of it. With undeterred determination, we continue to focus on seizing every possible prospect to become the go-to contract manufacturer for FMCG business. We are highly convinced that contract manufacturing as a subcategory of the FMCG universe remains very relevant and is only becoming more relevant with time. This is expected to have a simultaneous impact on the sector. We believe the next couple of years are going to be exciting in terms of growth for the contract manufacturing industry. We are enthusiastic about the future and are working hard on a pipeline that shall only consider moving ahead in one direction, onward and upward. Thank you again for joining on the call today. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or Strategic Growth Advisors, our investor relations advisors. Here's wishing everyone an affectionate and a warm Raksha Bandhan. Stay healthy, stay safe. Thank you so much.
Thank you, members of the management. Ladies and gentlemen, with this we conclude today's conference call. Thank you for joining us, and you may now disconnect your line.